everyone, welcome back to Invested, where we talk about wealth as being more than just money. Our partners Paul Rand, Joel Rand, and Sarah Minikari will bring in guests and industry thought leaders to chat about meaningful topics on personal finances, health and wellness, ideas for your business, tax planning, and other key issues that impact our lives and our livelihood. So thank you for joining us, and we hope you find our discussions not only practical and educational, but maybe sometimes a little thought-provoking. With that, let's get to the episode.
Hello, and welcome back to the Invested Podcast. I'm Paul Rand, and today I'm joined by Jared Walker from our team as we speak with Bill Puggini from Vanguard about a very important part of our investment world, exchange-traded funds, or ETFs as they're more commonly called. Bill Puggini is a senior portfolio specialist with Vanguard Financial Advisor Services, where he consults with advisors on investment thought leadership and Vanguard's full range of investment solutions. Bill joined Vanguard in 2008, and prior to his current role, he helped build out the Vanguard Advisor portfolio analytics and consulting offering. He's worked with advisors to aid them in their portfolio construction process, and that's given him extensive insights into how top advisors around the country construct their models. Additionally, Bill served as an enterprise investment resource on strategic initiatives such as the launch of their factor-based ETFs, and that included designing and implementing Vanguard's factor analytics tools for the web. Bill earned his finance degree from the University of Arizona and holds his FINRA Series 6, 7, and 63 licenses, in addition to the Chartered Financial Analyst designation, or CFA. Today, we'll talk about how the ETF industry has grown exponentially over the last several years and now makes up a section of the market measured in the multi-trillions of dollars. We'll touch on how ETFs are structured, how they trade, some of the differences between ETFs and more traditional types of mutual funds, and some of the different strategies now being used in the ETF format. So, without further delay, let's get to our conversation with Bill Puggini from Vanguard. Hi, and welcome back to Invested. Thank you, Bill Puggini, for joining us. Bill Puggini from Vanguard, and we're here to talk about ETFs, which is a huge component in the investing world. And we're going to talk a little bit about the history of that and how much the total pool of assets that ETFs make up in the investing world now. But thanks, Bill, for making the time to join us. I appreciate it.
Yeah, likewise. Thanks for having me.
So, ETFs have been around roughly a quarter century-ish now, and they've grown to be in the trillions of assets now. Can you walk us through maybe just a brief history of the ETF strategy and the ETF, and by the way, ETF exchange traded funds, if we haven't made that clear by now, sort of how they came about, the evolution since their introduction, and what kind of role do they play in today's investment world?
Yeah, absolutely. Look, so the first ETF was launched in 1993. There's an ETF that's actually now the largest in the industry, which is SPY. It's S&P 500 ETF that was launched by State Street. And I mean, there's some different stories revolving around exactly like why it was launched and how, but ultimately, I think, the real reasoning and the real benefit that ETF structure brought was really a democratization of investing, right? So it enabled investors to invest in a broad basket of stocks via an exchange as opposed to having to go directly through fund companies. It brought a structure that enabled and really pushed forward the lowering of costs, as well as brought forth some tax advantages too. We can certainly dig into more on those two big things. I think those are huge when it comes to ETFs. But that was in 1993, right? So that was about 30 years ago. You fast forward about 10 years, 2001. So it's about 8 years. That's when Vanguard launched our first ETF.
Was that the Vipers?
It was Vipers originally with Vanguard. Total Stock was our very first ETF, which is a very broad market U.S. stock market ETF. A year later, the first fixed income ETF was launched. And you fast forward to today, and there's over $9 trillion in the ETF market. And really, I think, I obviously glossed over a lot for any Seinfeld fans. I kind of like yada, 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 that, if you will. But,
you just yada yada about $10 trillion, I think.
Exactly. So, look, they started with essentially the most liquid basket of stocks in the world, which is the S&P 500. And slowly they have continued to sort of move into other asset classes that were always considered a little bit less liquid, maybe less was known about, the efficacy of launching an ETF in some of those categories. Fixed income was one, right? A little bit more of an illiquid market. It's not nearly as efficient as the stock market. You fast forward to today, now you've got things like active management. You've got, different alternative classes. So really what you've seen, especially over the last 10 years, has really been an evolution of not only what is offered in the ETF wrapper. You've seen tremendous competition on the price side, and really just a broadening out of what is available in ETFs. And, again, I think something we'll get into, but at the end of the day, it's just a different wrapper from a mutual fund, right? So I think a lot of what we've seen is just more things that are offered in a mutual fund wrapper being available, for ETF investors as well.
We sometimes get, with meetings with newer investors, and we're talking about how, portfolio implementation and how we do asset allocation and, for which category of investments we use which vehicles. And it can get a little confusing for some newer investors on the differences between, hey, what's an exchange traded fund? What's an open-ended mutual fund? Because, quite frankly, most people live in the world we live in and don't speak the language we speak. So, I think a lot of investors are used to that sort of 5-ticker open-ended, mutual fund that has the daily. Can you just talk a little bit about the differences between the structure of an ETF and the sort of traditional open-ended mutual fund?
Yeah, absolutely. And we can sort of lead that into some benefits maybe too of the ETF structure, kind of like why it has certain advantages or even disadvantages. But I mean, from a real structure standpoint, I mean, the biggest difference is that ETFs are, largely traded. About 90% of the trading in ETFs happen on an exchange, meaning that, it's one person selling an ETF and another person buying that ETF.
More like a stock.
More like a stock, exactly. Just like how a stock would trade. A mutual fund, on the other hand, so you have a company like Vanguard, and you essentially deposit money or make a purchase. You give that money directly to Vanguard. Vanguard takes that cash and then invests that cash. In exchange, gives you shares of the mutual fund, but they then have to take that cash and go buy the underlying securities within that fund. There's some mechanisms as to like how ETFs are able to operate on an exchange. It can get a little bit complicated, but again, really at the end of the day, I think that's the biggest difference is that ETFs are created via on the exchange itself. The dollars are typically trading hands between whoever is selling the shares of ETFs and whoever's buying those same shares. Which means, every transaction, you don't have to have a fund company like Vanguard going in and buying and selling individual securities. And so that's one of the ways that it can be more efficient than a mutual fund structure.
And I know, that also impacts the tax advantages, which we'll talk about a little bit later. But
so, Bill, you touched on kind of the evolution of ETFs and maybe some of the differences between open-ended funds and ETFs. Can you touch on why ETFs are less expensive than open-ended funds, and maybe touch on another, benefit of ETF structure, such as the tax efficiency that Paul just mentioned?
Yep. Yeah, sure. So, I mean, in terms of why they're cheaper, right? I mean, like what I just mentioned in terms of like how they trade on an exchange versus, a company having to take cash, deploy that in cash and securities, it adds operational complexity. On top of that, the fund companies have to do all of the record keeping. You have to distribute those funds through a custodian. There's just a lot more hands involved, and like like the actual transferring of cash and shares that have to happen versus just, me just buying it off of you in the secondary market, for instance. And on top of that, right, like you have to sort of predict and be able to deploy the cash that's coming in on a daily basis or out. And it's, again, it's not to really say that mutual funds are inefficient. It's just that ETFs, I think, just cleared out some of those operations hurdles, which just makes it a little bit cheaper. And you'll still find funds out there that are cheaper than ETFs, but I think like what you're starting to see as more common is when there are ETF versions and a mutual fund version. Usually the ETF version is just a little bit cheaper. And I mean, I think the real benefit to investors right now is like we're talking about things that are maybe like 1 to 2 basis points in terms of expense ratios, like 1/100%. Whereas, even just 10 years ago, the difference in pricing was much larger than that. But now we're focusing on things that can really, the more efficient things get, the more you focus on the smaller wins and the efficiencies of gaining, 1 to 2 basis points today is important. Whereas, 10 years ago, you're talking about things that potentially had differences of like 10, 20 basis points.
Yeah, well, and I, back in the day, it was not unusual to have a mutual fund that was charging 2 point something % for a management fee. So, over 200 basis points. And now you're talking about 1 or 2 basis points, a hundredth. I mean, so that actual 2%, or in some cases 3% when they were super egregious, is now just returned back to the investors' returns.
Right.
Not to say that they're all managed the same. I don't mean to imply that, but that does add to the returns.
Right. Yeah. So I mean, basically what we're getting at is like a lot of the really big wins were initiating the ETF structure, and now that they've come a long way, they've created a lot of price competition. Ultimately have lowered prices for investors across the board. And now, any little win you can get with 1 to 2 basis points here and there is kind of how you maximize that.
But I think, so if I got what you were saying, sort of the traditional mutual fund, I'm running a portfolio. I have so many shares of this portfolio on a daily basis. You buy it, you're giving me cash. I got to go buy more of the underlying securities to make my portfolio. You sell your shares back to me. I have to go sell the underlying. And with an ETF, there are outstanding shares, and they can be traded directly between buyers on the market, and don't necessarily have to come back to the fund company for redemption and creation of shares.
Exactly.
Yeah. And so, and some of that tax savings is, hey, if I'm running a portfolio and people are either, running in and or getting out of that mutual fund, and I'm having to do trades on the back end to make up for that, that's going to create a lot more capital gains and losses that may or may not benefit the individual person that's buying and selling that mutual fund.
Yeah. So, I mean, to really get into the tax benefits, it really comes down to sort of the mechanics of how the two structures work, right? So just like you mentioned, if I, as the mutual fund company, and you want, say you're selling shares, right? You have to go out and sell some of those securities. Well, if there's a gain in those securities, that now becomes part of the accounting for my fund, right? And that gain ends up getting distributed, to all shareholders, and you end up getting taxed on that, just like you would any capital gain if you bought or sold a stock. With an ETF, it really gets down to the mechanics, right? So I mentioned, most of the trading occurs in two people trading it back and forth. But there is a mechanism, I should say, for like how you actually create shares and how new shares are created. When demand is outstripping supply, you're going to have more buyers than you would sellers. That's going to push the price up of the ETF naturally. And then market makers, the same ones that, that set prices and help, keep spreads really low on stocks, they do the same thing for ETFs. And so what those market makers can do is actually go out and buy all the underlying stocks for that ETF. So like, let's just use an example. Like say you just have 10 stocks in your ETF that are worth $100 combined. And the ETF, there's a lot of demand for your ETF. So it's actually selling in the market at $101. Well, the market maker can buy all the securities for $100 and then create an ETF, sell it back into the marketplace for $101. So they make that dollar. They also help, put more supply into the market, which keeps that price closer to what the value of the underlying stocks are. Now, the reason for the tax efficiency is, again, there's no dollars and cents trading place, right? It's all trading the stocks back and forth. So, as we quote unquote sell stocks in an ETF, a lot of times you're actually just transferring those stocks to the market maker. The market maker is then selling them in the open market. So you're not actually transacting in those dollars. Yeah. You're sort of trading everything. And that again, it acts as sort of a shelter over the capital gain, the same function that causes capital gain distributions in a mutual fund wrapper.
And I'll go through that, especially, some clients that come in with sizable portfolios and they have mutual funds in there and what I like to say is, hey, Bill and Jared and Paul are the three owners of a mutual fund. And that the traditional sort of open-ended mutual fund, not an ETF, that mutual fund goes up in value, up in value, up in value over time. I decide to get out for whatever my reasons are. The fund company has to sell some stocks to give me my cash back. And so what may happen is, even though Jared and Bill haven't sold their mutual fund at all during the course of the year, you guys may get a capital gain implication at year end because I sold. Right, we all sort of share in that, and that's less likely to happen in the exchange traded fund world. Is that kind of a sort of good synopsis of that, or?
Yeah, exactly.
Perfect.
Now that our listeners have some of the mechanics behind ETFs understood, Bill, can you talk about any additional risks associated with ETFs and maybe how those might differ from a mutual fund?
Yeah, sure. And maybe just to kind of restate like advantages of ETFs versus disadvantages relative to the mutual fund structure, right? So, first and foremost on the advantages side, we talked about capital gains, a lot less likelihood for capital gains on the ETF side, expense ratios that are sort of on average, generally a little bit cheaper in ETFs. And then the other one that we didn't really just hit on too much is intraday trading. So the ability to sort of transact and know exactly what you're transacting at the moment that you do it, versus an ETF. So, submitting a transaction, you have to wait until 4 p.m. to know exactly how many shares you've bought or how many you've sold. So now in intraday trading is maybe we'll stick on, because that can be either an advantage or a disadvantage, depending on how you look at it. Right. So I think the advantage of the mutual fund structure is that you're always transacting at that exact, what we call NAV or net asset value, the exact underlying value of what you're buying. With ETFs, that price is reflected in the market. As I mentioned, there are a lot of mechanisms that sort of keep the price of an ETF like very strictly tied to what the underlying basket is worth. But it can ebb and flow a little bit. And so you have to, you kind of have to know what you're doing to a degree when you're buying and selling ETFs. And frankly, I think financial advisors, financial intermediaries, professional investors have really are one of the driving forces for why ETFs have become so popular. They become popular in retail with end investors, but again, a little bit more complexity when it comes to trading an ETF, which also means you don't always have the same flexibility when it comes to things like setting up automatic investments or automatic withdrawals, and really those would be the biggest drawback for the ETF structure relative to mutual fund.
So, and when you're talking about some of those drawbacks and some of the differences, and And we talked about the evolution of going from, pure, we started off with SPY with tracking and index, and, not to get too far in the weeds and talking about tracking errors and how close we are to what we're trying to track, although that's important. Can you just talk about sort of the differences between index tracking and then some of the newer strategies that have come out that it kind of went from index to sort of smart beta to now actively managed ETFs and the evolution of the complexity of some of the strategies?
Yeah, for sure. So I think that's sort of what we yada-yada'd over earlier. But yeah, essentially, right. I mean, you're just seeing more mutual fund style investments making their way into ETF wrappers as ETFs have been around for a longer amount of time. We learn more. We understand via different market environments how the ETFs react, et cetera. But yeah, so I mean, right, the first ETFs were, and still the majority, frankly, of ETFs are passively managed, meaning they track an index that's published on a daily basis. They're also transparent. ETFs publish their holdings on a daily basis, which is more frequent than mutual funds are required to do. And so, again, 15 years ago, when active management was a little bit more prominent than it is today, before indexing overall overtook it in terms of like total assets. That was seen as a really big deal, right? Active managers don't want to give up their quote unquote special sauce, so you can see what they're trading on a daily basis. So really, you've seen sort of this evolution in ETFs. So went from indexes that were purely transparent and always have been transparent. Say, hey, there's no harm in investing exactly how these indexes invest, and creating ETFs that track those indexes as the vast majority of them do. Over time, Vanguard actually 2018, we launched our first active but rules-based ETFs, meaning they didn't track an index that was created by a third party, which is the case, right? So when you think of S&P 500, right, S&P Dow Jones, that's who creates that index. Then a company like Vanguard or State Street tracks that index that's created by S&P. In 2018, Vanguard launched our first active equity ETF, which was very rules-based. That kind of is similar to like what you're referring to with smart beta, where it was, hey, these aren't things that strictly follow, a market cap weighted index, meaning, the largest securities, the securities that are worth the most, get the highest weight. You start, playing around with different rules for those indexes and investing ETFs in ways that follow those different types of rules. So we've seen that happened in, call it the middle part of the 2010s, the mid-teens. And then towards the latter half and more recently, we've started to see more traditional active enter the space. And again, the challenges there have always been, transparency, having to show your hand on a daily basis in terms of what you're investing in, what you're buying, what you're selling. And then also, concerns potentially about capacity. There's sort of a finite amount that most active managers can manage in the marketplace. With a mutual fund, you can kind of control that spigot. You can turn it on or off. You can close a fund to new shareholders to help control that capacity. There's no shut-off valve with an ETF.
Right.
So there is some concern that, hey, if you get too big, there's no way for you to shut it down. So how do you manage that excess capacity? I think that's one of the reasons it's taken a little bit longer to introduce active. But then, one of the biggest hamstrings towards active has always been the relative tax inefficiency, right? As you are trading those securities and you're generating capital gains for investors, which should be a good thing, you're ultimately having to distribute that as a taxable event. That happens because active funds trade much more frequently than index-based strategies. So active managers have generally, paid out higher capital gains distributions than indexes have. And so the ETF structure being able to sort of help mitigate that tax efficiency, I think can help level the playing field a little bit for active managers. And that's why we're seeing some more fund launches more recently and like sort of that more traditional active, like stock picker type of strategies, as well as active fixed income.
On the topic of actively managed ETFs, Bill, can you talk a little bit about benchmarking and performance tracking? In your opinion, should different methodologies be used when implementing a strategy of ETFs?
Yeah. So, I mean, when you're talking about like different methodology, you're talking about like different indexes based on the strategy.
Right.
Yeah. I mean, look, I mean, and let me know if this is what you're sort of getting at. But I think one thing that we see a lot of, um, when people are creating a portfolio of ETFs, say, hey, I want to have my large cap ETF and I want to have my small cap ETF. A lot of times people are say using an index that follows like S&P 500 for large caps. And then they might say something like Russell 2000 for small caps. And one thing I do think is important is to use the same index provider really across a portfolio, because their indexes are designed to line up. When you think about the S&P 500, it's investing in like 500 of the largest securities in the US. The Russell 2000 is investing in the smallest 2,000 out of the largest 3,000. So you think you're getting basically name 1,001 all the way down to 3,000. So if you're investing in those two things, you might have noticed just from those words, like you're missing 500 stocks in the middle. And I think that's a thing that we see a lot when we're looking at investor portfolios, is sort of these gaps and overlaps that are created by investing in different indexes and not understanding exactly how they line up. But again, I think that's an area where sort of intermediaries, financial advisors can help create those more efficient portfolios.
There's in the different styles of exchange, and you mentioned earlier that we now have bond exchange traded funds. And inside the equity exchange traded funds, there are equities that pay dividends. And then inside the bond exchange traded funds, there are bonds that pay interest. How is the income handled? What can an investor sort of expect on getting that income? How is that? Is it transferred right to them, or how does that work?
Yeah, so it's just like you would expect from from a mutual fund structure, quite frankly. You'll see with stocks, maybe fixed income's a little bit different, but typically for a bond fund, it's going to pay out at the end of each month. You're going to receive cash as a quote unquote dividend or as income from that income that's accumulated over that course of that month, is then distributed to all the shareholders based on how many shares you own. And you can typically either set to receive that in cash or to reinvest. Same thing is going to happen for stock funds. Typically that's either quarterly or less generally for a stock fund. But again, you're going to be distributed those dividend or income payments, based on the income that has accumulated from all of the underlying securities in the fund, and then they'll be paid out to you to either in cash or as a reinvestment back into the ETF shares.
Great. For many of our clients, Bill, we use non-traditional asset classes to help reduce risk and provide better longer-term outcomes. Can you speak to some strategies that are not traditional bond or stock strategies?
Yeah, I mean, there's a number of them, right? I mean, it's just like we talked about, sort of with the evolution of the ETF, with the ETF structure, sort of, taking on more categories that have been available for maybe a little bit longer in mutual funds. But you've got things like commodities. You have things like Bitcoin is a more recent one. You have things like buffered ETFs, leveraged and inverse ETFs. So, buffered ones is one that's been catching on a lot lately. It might say, hey, we're going to invest you in the S&P 500, and the amount that you can sort of make an appreciation is 10%, but the most you can lose is 5%. And they'll do that, via different derivative products that are under the hood. So different things to sort of kind of engineer the return structure under the hood of the strategy. But again, all their other alternative asset classes, sort of such as like commodities and managed futures, things like that folks can use to sort of have investments that are uncorrelated to traditional stock and bond investments.
Are there some strategies that wouldn't be a good fit for the ETF structure?
Yeah, I think so, right? And I think the list is probably getting shorter than it would have been 10 years ago, for a lot of the reasons that we've discussed, right? It's like as these things have evolved and sort of been created, and we're able to get real life data on what's happening. And a lot of them have actually, I would have said probably 10 years ago, like anywhere where you have less liquidity is going to be a little bit of a challenge for an ETF. But what we've actually seen is because, like that was even said about fixed income. Years ago, it took almost 10 years after the first equity ETF for fixed income ETFs to launch. The concern there was lack of liquidity and lack of efficiency. But what we found is that ETFs actually, because they trade between you and I, and it's you and I trading shares of the ETF, we don't have to transact in the individual bonds nearly as frequently. And so they've actually helped shelter from some of the illiquidity in different asset classes. And so we've seen that over time. But that's still sort of the measure, I think, it makes the most sense when you think about what would struggle in an ETF structure. I think maybe it's just getting farther down. Like liquidity is a spectrum, right? You have the S&P 500, you have fixed income, and then you have things like buying a house that are still way on the other extreme. And those types of things that really, I guess anything that really is difficult to value on a daily basis would be really tricky with an ETF structure where you're really trading it based on what you think it's worth and what it's valued at the end of the day. If you don't have that sort of price discovery and price transparency, it makes it really tricky to understand what you're actually buying and what you're paying for it and what it's worth. That's not a great thing. So things like private equity, private real estate, anything where it's illiquid, not only from a trading perspective, but then if you want to transact in the fund, and then ultimately at some point that's going to trigger necessitate sort of the trading of the assets under the hood. Those more illiquid investments are gonna struggle with that, and you might have things like real estate and private investments start to spin out things like K1s and things that make it more operationally challenging for investors. So I think like private real estate, private equity, some of those types of asset classes would be the ones I would think of the most.
You mentioned the sort of the defined outcome ETFs where you have protection on the downside in exchange for a capped upside, which in my opinion, that's a great example of a strategy that's been around for a really long time, but now it's available in a convenient ETF wrapper like that. It's done with underlying options and using puts and calls to generate income to offset the cost, et cetera. But now it's available sort of right off the shelf and with clearly defined parameters, which I think is a fantastic example of how ETFs have matured and a great use of them. Another strategy you mentioned a little bit before was the introduction of leveraged and inverse ETFs. Can you just talk a little bit about those and how they work, and particularly because we spend a lot of time cautioning investors about how they're not as simple as you think they are.
Yeah. I find myself doing the same thing even with friends of mine. I think they're broadly misunderstood. I mean, the general reason those types of ETFs were originally launched was actually for short-term hedging, right? So whether you have as a business, potentially you might have a short-term position in oil that, isn't really part of your business. So maybe you buy a leveraged ETF, a leveraged inverse ETF that sort of offsets that exposure to the oil until it rolls off your balance sheet, or sort of like what you're doing. So like, you can think of like an airline or even like farms, like using potential structures like that. And that's really meant to hedge those exposures over like the course of days. Yeah. What a lot of folks don't realize is there are a lot of derivative contracts that are underlying that. It's how it's run. And actually, if you invest in those for a long period of time, what you'll see is you're constantly paying to roll over those contracts,
Right.
and the price just gradually goes down. So it's almost like you're facing this like wind resistance the entire time that you're investing those, and they drop in price, and then they have a reverse split. The price goes back up, and then they sort of gradually come down. So if you invest in those for a long period of time, you're just sort of naturally, almost inherently losing money. Now, counter to that inverse piece of it, that's going to sort of counteract whatever's happening. But you're paying a lot more in fees and expenses, and that's causing those investments to essentially go down in value over time. And Vanguard actually doesn't allow the trading of those on our retail platforms because of that. The just generally misunderstood nature of those, as again being really a financial engineering product that was created again for very short term hedging of very specific exposures on your balance sheet, and not really meant as a speculative or investable asset class.
Yeah. And I think, a lot of people don't understand when you're looking at something that's, hey, it's a 2x or a 3x on the S&P 500. Hey, I'm a believer that over time the S&P 500 is going to go up. I think there's a lot of misunderstanding that most of those are structured so that it's giving you 2x or 3x of a daily return, not a return over time. And that performance delta, the difference between amplifying a daily return and amplifying a return over time, is a huge difference. So
yeah, exactly.
And plus the added expense that you're talking about.
Mm-hmm.
With all the benefits we talked about today in regards to ETFs, including lower fees, ease of implementation, tax efficiency, why aren't ETFs available in 401k plans?
Yeah, good question. I mean, I think when you look at the two biggest benefits of ETFs, it's taxes, as we talked about, or tax efficiency, and it's lower expenses. You don't really have those issues when it comes to 401ks. So first, on the tax side, even if capital gains are distributed there, you don't have to pay taxes. That's the benefit of a 401k type plan. So right away, sort of taxes are ruled out. On the expenses side, you have collective investment trusts. So a lot of times when you're investing in a 401k, that's a pooled investment. You're getting a ton of scale from different companies that are invested in that, and you have really predictable cash flows. As paychecks come in and contributions go in. And so actually a lot of times, those are called collective investment trusts, basically the same thing as a mutual fund, but sort of split off for a group of individuals. And so a lot of times you actually end up getting just as low of expenses, if not lower, there than you would in other forms and other wrappers. So you sort of don't have the same motivation when it comes to 401k plans to go after those efficiencies of the ETF, because you're still largely either sheltered from it or getting that advantage via a 401k. And then on top of that, right, I think there's some regulatory hurdles as well in terms of creating a plan lineup, making sure they're suitable, making sure that you don't have investors buying things that they are not suitable for them in a 401k plan. And that's a little bit more operationally accomplished with mutual funds than it is with ETFs, as ETFs again are traded on the open market and on brokerage platforms. So it is possible some 401k plans have that, but again, I think sort of containing the investable lineup and still having access to products that are very low expenses and not being subject to those capital gains make them a little just lowers the motivation, I think, for those types of plans.
Yeah. And I know our time's limited and we got to get you back to your real job instead of entertaining us with all the questions. But with all of these massive flows coming into ETFs and the talk about the evolution of what's going on, and now there are a lot more thematic sort of strategies that are being implemented through ETFs. Where do you sort of see the the world of ETFs heading, or what do you think is going to be like the next big development that we should expect?
Yeah, I mean, it's hard to say exactly what it's going to be, right? But I think the big one that's sort of in progress right now is the proliferation of active. I mean, we're starting to see a lot more launches for active products, and as we mentioned, right, that's been an evolution of active. Everything from like rules-based and systematic type strategies, like more quantitative type strategies, to now more fundamental. So what I mean by that is like, quantitative is more of like a rules-based, something you can almost run with a spreadsheet, whereas fundamental is more individual stock picking, individual bond picking. Vanguard has launched some active ETFs within the fixed income space, areas that are very broad, hold a large number of securities, very diverse set of securities. So you're not overly concerned with capacity in certain areas, like I mentioned earlier. And, I think that's what we've largely started to see, and probably what we'll start to see a little bit more as the ETF wrapper can sort of, level the playing field from a taxability with index-based strategies. I mean, active already has it difficult enough and trying to outperform with generally higher fees than passive. So with the taxable nature of them, that just makes it even more challenging. And so again, it's sort of with that the initial purpose really of the ETF wrapper I mentioned early on was the democratization of investing for individual investors. Well, now we're starting to see that democratization of index versus active, so folks can have those. What we've largely seen is really it's the lower cost active that's surviving sort of this shift in preferences towards passive management that we've seen over time. So we're seeing those large cap. We're seeing those, I should say, lower cost active funds, continue to stick around and succeed. But I think seeing them shift into an ETF wrapper will help level the playing field there. And I think we're much more likely to continue to see, active managers launching ETF strategies as a result of that. And then, really from there, I think it's just more of an encroachment from the ETF space into the things that mutual funds are doing. So, whether it is continuation and things like alternatives, multi-asset class type of, balanced investments, just seeing more of that sort of transition into to areas that have traditionally been held just within mutual funds, being done within ETFs as again, I mean, I don't know how much we've necessarily hit on it, but we've talked about a lot of advantages and disadvantages. But I mean, at the end of the day, they're both essentially a mutual fund structure. They just trade differently.
Yeah.
And so I think you're just going to see a lot of the blurring of the lines continue between ETFs and mutual funds, really.
Yeah. Well, that's great, and really appreciate you taking the time to talk to us. It was awesome. I mean, we could keep going on and start talking about asset allocation ETFs, and I was talking to one guy, and he said there's an ETF for anything you want. You want to invest in companies that only have CEOs with red beards. There's an ETF for that, but we'll get another time. Really appreciate you taking the time to talk with us.
Yeah, absolutely.
So much.
Yeah, no, I enjoyed it. Appreciate the invitation, and happy to do it anytime.
Okay, great.
So that's our episode for today. Thank you for listening. If you found this topic interesting or useful, please let us know. Or if there are other topics you'd like us to address, let us know that too. We'd love to hear from you. Thanks for joining us, and thanks for being invested.
The RAND Group is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced
referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other data information contained in this presentation is provided as general market commentary and does not constitute investment advice. The Rand Group and Hightower Advisors LLC or any of its affiliates make no representations or warranties express or implied as to the accuracy or completeness of the information or for the statements or errors or omissions or results obtained from the use of this information. The Rand Group and Hightower Advisors LLC assume no liability for any action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced in the document. Such data and other information are subject to change without notice. This document was created for informational purposes only. The opinions expressed herein are solely those of the author and do not represent those of Hightower Advisors LLC or any of its affiliates.